Okay, so chapter 6 and 7, which we combine into one topic, is the use of budget for planning and control purposes. So let's start out quickly reviewing some of the theoretical concepts. A budget, as we're going to understand it for the purposes of this class, is merely a quantitative expression of any plan that you have for the future. So it has a slightly different meaning from the sense in which you use it in everyday conversation. Okay, your personal budget, your government budget, you usually think about it as figuring out exactly how much you are able to spend on different things that you need to spend money on. But the sense in which we use the word budget in a corporate setting or in a corporate context is very different. Okay, a budget is merely a quantitative version of what it is you are hoping will transpire in the future for a fixed period of time, normally for a period of, say, a year. So every number that figures on an actual income statement, balance sheet and cash flow statement for a particular period will have a budgeted version for the upcoming period. Okay, so all accounting periods are sort of book-ended by budgets and actuals. The beginning of the period, there will be a budgeted set of financial statements that sets the expectations for how you want to perform over the course of that accounting period, a budgeted income, budgeted cash flow, and budgeted balance sheet. And at the end of the period, you will prepare your actual income statement, balance sheet, and cash flow statement, and then you compare the two. Okay? Now, as soon as we talk about budgeting, it's important to put it into its place in the overall planning and control cycle. So everything that an organization does, you can think about as falling into this planning and control cycle. Normally at the beginning of a period, what do? You aspire, you set out your expectations for how you want to perform, and you try to put them put them down in quantitative form as specific as possible. So that process, we know it's called planning or budgeting. Now, what happens once you put the plan down on paper and communicate it to everybody? Well, everyone goes to work to implement various aspects of the plan. It's at this point that what we call the control phase of the cycle picks up. Okay, and control actually is more important to us as managerial and as financial accounting. So the idea of control usually refers to trying to figure out whether your plan is succeeding or not. That's really control in one sentence for you. It involves a number of smaller things to first define what success means to you, how you're going to measure success, right? And there can be a number of metrics. It can be growth in revenues, growth in income, growth in customers, growth in profitability, return on investment, and so on. So you want to define how you want to measure success, and then figure out a way to pick up all of those variables, to pick up all of that data on a constant basis. Keep comparing your actual performance back to. What do you compare your actual performance back to? What are you going to compare your actual performance to? To budgeted performance, right? And then there are going to be differences between your actual and your budgeted performance, right? What do we call these differences? Variance. And a variance can be relating to any number, right? A difference between the actual revenue and budgeted revenue is a revenue variance. Difference between actual cost and budgeted cost is a cost variance. So you can have any number of different types of variances depending on what it is that you're budgeting and comparing. So you figure out differences between your actual and budgeted. You end up with a number of variances because your actual performance rarely, if ever, comes spot on in target with your budgeted performance. Then once you have your variances, you want to sort them out into good variances and bad variances. Okay, and we have names for them. We call them favorable and unfavorable variances. A favorable variance is anything that indicates that your actual performance is better than your budgeted performance. An unfavorable variance is anything that indicates that something is going worse than you budgeted it to go or that you expected it to go. Right? What do you do with these favorable and unfavorable variances? Well, you figure out a way to not make them happen next time. Right? So with an unfavorable variance, you find out the root cause, find out what's driving it, and you try to correct it so that it disappears next period. If it's a favorable variance, that means someone is doing their job better than you expected them to. So naturally, you don't want to suppress that. You want to encourage that. So you can figure out a way to reinforce the behavior that's creating a favorable variance. Find some way to make other people also do the same thing and to sort of multiply the positive effects of whatever is going on. Okay, so this in a few sentences encapsulates everything that we do in the planning and control cycle, and you recognize that you cannot have a planning and control cycle unless you have a quantitative plan at the beginning of the period. You can't do any variance analysis unless you have a budget that was created upfront, okay, or a priori. So last Tuesday we started with a comprehensive case that illustrates the entire process of control. Okay, and that's the web company case. So I would suggest that you turn to that page in your notes or wherever it is that you have this information put down. And I'm going to quickly review the facts of the case, and we're going to proceed to break down a level 1 and level 2 variance analysis out of this basic information. Okay, so the web company case is starts off on page 7 of your notes. Okay, but so we've worked our way through all of this before, so you should have it in your notebooks as well. So this is a company that makes jackets, and we have here a very simple production scenario. They don't have any opening or closing inventory for the year, and their production is exactly equal to their sales. So they sell everything that they make this year, okay, in any given year. So it's a very simplified scenario. This is the budget that they prepared for themselves at the beginning of April 2006. Okay, so this is a monthly process. This is the budget for 1 month. This is the performance that actually came in at the end of the month. So keep in mind the fact that these two pieces of information are prepared at different points in time. This is prepared at the beginning of the period, and this is prepared at the end of the period. Okay, so we budgeted to sell 12,000 jackets at a selling price of 120 per jacket. We had the following cost categories: direct materials, direct labor, some variable overheads, and some fixed overheads. That gave us budgeted operating income of 108,000 for the period. Now, this is what actual performance looked like. Instead of selling 12,000 jackets, we only made and sold 10,000. Okay, but every jacket we sold at a slightly higher price than budgeted of 125. However, the fact that we sold those jackets at a higher price was insufficient to compensate for the lower volume, and so we ended up with lower revenue than we planned. Only 1.25 million vis-a-vis 1.44 million is budgeted. Okay. Now, naturally, since we made only 10,000 jackets, clearly all our actual costs are also going to be what? Lower or higher than budgeted costs? Lower, because we have a lower volume, right? So that's basically what you see here for most of the costs, not for all of them. So you see here your direct materials cost for 10,000 jackets works out to about 622,000. Okay, so yes, your overall cost is lower, but that's mainly because of the effect of lower volume. Now, per jacket, so every jacket that you did make, however, you ended up going a little bit over your budgeted cost per unit. So every jacket was supposed to cost you only $60 in materials, but it ended up costing you some 62.16 in materials. Okay, and you have a similar situation with all of your other costs. Labor was supposed to cost you 16 a unit, it ended up costing you 19.8. There are many different reasons that could drive these differences, okay, and we're going to investigate them one by one. Variable overheads also ended up costing you $13.05 a unit instead of 12, and your fixed overhead also went about 9,000 over. Okay? So we have, it's instructive to note this stuff down here. We have a number of things that went differently from budgeted, and we looked at all of these last class. Our actual sales volume lower than budgeted. Our actual selling price was higher than budgeted. Direct material cost per unit also higher than budgeted. The same with direct labor cost per unit. The same with variable overhead cost per unit. and your fixed overhead costs in total were also greater than budget. So pretty much every single number came in differently than budget, right? So we start out any variance analysis by computing the most fundamental variance, and that variance we call, what is the first variance that we compute in the variance analysis? The overall income variance. It also has another name. Did we get into that last class? It goes by another name. Never mind. We'll call it the overall income variance for the time being. Okay. And that's the difference between your budgeted income and your actual income. And what does it work out to? That's right. 108,000 minus 14,900. Works out to 93,100 what? Unfavorable, because actual performance is that much worse than expected performance. Okay? Now, this number is certainly useful because it tells us that our actual performance is about 90% worse than budgeted performance. But it's not that useful precisely because we have so many different things that went wrong. Okay? And what the overall income variance tells us is merely the aggregated result of all the things that went wrong in the organization or everything that went worse than budgeted. Okay? Now, this is a very important point, so it's worth repeating. Now, anytime you want to come up with a plan of action, okay, any plan of action involves a certain implicit priority, right? You want to figure out what the most important problem is so that you can direct your attention to fixing that. Then you want to figure out what the next big driver of your losses is. And then finally, if you have the time and the energy, you move on to fixing the relatively minor problems, right? So clearly, first of all, you want to have some kind of priority ordering. Okay, which of those 1, 2, 3, 6 factors has been responsible for driving the big chunk of this negative or unfavorable variance, right? So that's one reason why this number is not useful, because it only gives you the aggregated result of all of those 6 factors. It doesn't tell you exactly how much of the variance was driven by or came from each one independently of those 6 factors, right? So that's one reason why this is not very useful. The second reason why this is not useful is because if you look at each of these items, okay, each of these items can be traced back to a specific individual or group of individuals or division of the organization, but not to the same individual or group of individuals. Okay? Now, the first item on top of here is the sales volume issue. Not knowing anything more about this, you would immediately trace responsibility for a sales volume problem to your marketing people. Those are the people that you would go and ask your first line of questions to. Now, you look at the second set of issues here. These are all cost issues, okay? These are all cost overruns. So your cost efficiency was not as high as you budgeted for it to be. And again, not knowing anything more about it than we do right now, you would trace responsibility for these issues back to the operations or the production or the manufacturing division. And these are very, very different divisions in the organization. It's completely different line of command, different set of people that are responsible for it. Okay? So that's another reason why it's important to know not just the sum total of all the factors that went wrong, but you also want to know exactly how much of that variance came from different parts of the organization, because you would speak to a different group of people for everything that went wrong. Okay? So as you figured out by now, our main task here really is to take the variance and disaggregate it into a number of smaller variances, each of which can be uniquely attributed to one of these particular causes. Okay, so that's really the main task here. So classically, the way in which you always start out, and there are certain methods that have been put in place for variance analysis just to make it easy for you, because every scenario can be very complex and can bring with it a different set of causes. Okay, so there's a standard sort of simplified model that you follow to do this. So you always start out by trying to disentangle sales volume from all of your other effects. Okay? And so in this particular example, Okay, we did this in the last 5 minutes of the class, which is very rushed. This particular example, and someone described to the class how it is you would go about disaggregating the portion of this variance that is driven entirely by the sales volume effect from the portion of the variance that's driven by all the other effects. We want to separate out the sales volume effect from all of the other effects. And we sketched the method at the end of the class. Can anyone describe it for us? Use the flexible budget method, but can you describe to us what that is? We certainly do add an intermediate step in here called the flexible budget. You all remember that? We add another budget into the middle. That how is that second budget or the flexible budget composed? That's the more important question. How is it composed? You said we use the quantity from the actual. I see. How about the costs per unit? You didn't tell us anything about where we get that information from. Does anyone remember the way I described to you about how you should remember or think about the flexible budget? Okay. You guys are all talking, you're all absolutely correct, but there's a part to your answers that's missing. You're only talking about the prices. My question is, what about the costs? The price is not the only rate into which you multiply a quantity. There are also costs per unit, right? So neither of you have specified that, so that's the part that I'm looking for. Marissa? You're correct, yes. So all of this, it tends to be a little bit confusing. I don't want you guys to remember this in this mechanical kind of way. You take this from here and you take that from here, because that sounds like memorization, okay? And we don't like that. So here's how you remember the flexible budget, okay? Imagine that you were at this point in time again, okay, the beginning of the period, and imagine that you knew only one piece of information about the future, and that piece of information being what your actual sales volume was, how many jackets you eventually ended up selling, but no other piece of information. And then ask yourself, if I knew that one piece of information, what would my budget have looked like? Okay? If you remember it that way, then it becomes very obvious where each number should have come from. So really what the flexible budget is trying to do is it's trying to answer the following question. Assuming I had sold 10,000 jackets, but everything else had gone according to plan, what would my eventual income have been? Okay? So there are many different ways in which you can remember without having to memorize what the flexible budget does. The way I prefer to think about it is, what would the static budget have looked like if I had known back then exactly how many units I was eventually going to sell, but no other piece of information about the future. Okay, that makes it very clear where everything has to come from. So flexible budget is really going to be a composite. It's going to be a mishmash of your actual and your static. It's going to take all of your actual volumes and multiply them by your static budget rate. Okay, so go ahead and do that, and then let's stare at it for a minute and see what we get and how to interpret it. So your flexible budget revenues are 10,000 times 120, okay? That's 1.2 million. What is your flexible budget direct material cost? 10,000 times 60. This is 10,000. You know what, to save space? It's 10,000 at 12. How about your flexible budget fixed overhead? As what? This or that? As the static budget, because regardless of whether you expect to sell 12,000 or 10,000, theoretically your fixed overhead should be the same because it's fixed. Remember, it is not meant to vary with volume. Okay, so we put down all of this information. Gives you 600,000, 160,000, 120,000, 276,000. And so what is our flexible budget income? See? 44,000. Okay. So now really what we've done is, by adding this intermediate step in here, we're now in a position to take this variance, this overall variance that we calculated, and break it down into two pieces. So first, the difference between the static budget income and the flexible budget income. Okay. So we'll talk about that in a second. And second, into the next pair of differences between your flexible budget income and your actual. Now, the difference between your static budget income and your flexible budget income is 64,000, and this is an unfavorable variance, because keep in mind, whatever is on the left is always your budget. So this is your static budget, this is your flexible budget. They're both called budget, but which one has more actual information incorporated into it? This one. So this is the budget that you're comparing this to, and compared to this budget, the income of the flexible budget is 64,000 lower. Okay. So your first variance is a 64,000 unfavorable variance. Now tell me, what shall we call this variance? Why? Not only the same price, the same rates. That's a better way to describe it, because these are not prices. These are just rates. Okay? So you're taking the same rates, and really you see now why we constructed this particular budget the way in which we did. Because when you compare the static budget to the flexible budget, the only thing that's different between the two is that the static budget uses budgeted sales volume and the flexible budget uses actual sales volume. So the entire difference, you can infer from that the entire difference between the 108,000 and the 44,000 must come from the sales volume effect, right? That's what's accounting for that entire 64,000. And so just 64,000 unfavorable out of 93,000 and change unfavorable is really being driven by the sales volume effect. Okay? So this is our sales volume variance. Any questions about this? So really, about 2/3 of your overall income variance is being driven by your sales volume effect that's going on here. Now, I never introduced this term actually. I think we started out only calling this the budget, but then in the second step, when we add a flexible budget here, we call this the static budget in order to distinguish it from the flexible budget. So this is really the budget that you have at the beginning of the period, okay? And it's called the static budget just to distinguish it from the flexible budget. So really, we are now, from this point onwards, going to refer to this variance as the static budget variance. Okay? Okay, so now we looked at this comparison. Let's move on to this comparison. Okay? So now for a moment I want you to forget about the static budget. Imagine that it's not on the board and only compare the flexible budget to the actual. Okay? What is the overall difference? 44,000 minus 14,900 is how much? Again, is it a favorable or an unfavorable? Unfavorable, because always keep in mind which is your budget and which is your actual. When you make this comparison, which is the budget and which is the actual. This is always the actual. right? Because this is 100% actual information, okay? And now this is the budget that you're comparing to. So your budgeted income is 44,000. Your actual income is only 14,900. So this is most certainly an unfavorable variance. Now, tell me that 29,100 unfavorable variance is being driven by what? What is it being driven by? Sorry? The selling price. The selling price is higher than budgeted, the actual selling price. Yes, that's one factor. Is that all? Is that the only difference between the flexible budget and the actual? The cost rates. Just one cost rate, all of the cost rates, right? The direct material cost rate is higher than budgeted. The direct labor cost rate is higher than budgeted. Variable overhead rate is higher than budgeted. Overall fixed overheads are higher than budgeted. So really, this difference is being driven by everything else, right? All of this stuff. You agree? So it's difficult to give it a name because it doesn't come from just one factor. It's coming from the sum total of all of your other factors. So we're just going to call this the flexible budget variance. Okay? So flexible budget variance is 29,100. So let's start drawing a chart here. We started out with a static budget variance of, and now we've broken it down into two trial variances. When you add up these two variances, what should you get? When you add up the sales volume variance and the flexible budget variance, what should you get? You should always get the static budget variance, and this is a general principle in variance analysis. Anytime you disaggregate a variance into some X parts, when you put the X parts back together, you should get the original thing that you started out with. If you do not get that, that means you've done some of your calculations wrong. Okay? So we've broken it out into two variances, which should add up to the original. So your sales volume variance, 64,000 unfavorable plus your flex budget. Okay? So now we know one more piece of information about what happened than we did before. We know that 2/3 of that overall income variance comes from the sales volume effect. Right? The sales volume effect is really the big factor. And all the other 5 effects put together account for the remaining approximately 1/3 of that overall income variance. Okay? So if you were asked now to identify the single biggest factor that you as the manager should try to fix, you know that it's the sales volume effect. Now, let's try to get even more information. Okay? So what we're going to do is we're going to focus now on the flex budget variance, because the flex budget variance is the one that's still the sum total of 5 different factors. So it's going to try and disaggregate the flexible budget variance into 5 different variances. Okay, each of which reflect exactly how much is contributed by each of these factors. Any questions until now? You can see lots of puzzle faces. I'm happy to explain any of this again. No question? Can I move on? Okay, so let's look at this flexible budget variance now line by line. Okay? Now tell me, this is the flexible budget revenue, this is your actual revenue, right? What is driving the difference between the two? What factor? Your actual selling price being higher than your budgeted selling price, and therefore we call this the selling price variance, the sales price variance. And what is it in this example? 50,000 what? 50,000 what? Favorable or unfavorable? 50,000 favorable or unfavorable, guys? Actual revenues larger than budgeted revenues is a favorable or unfavorable variance? A favorable variance. Okay? So your selling price variance is 50,000 favorable. So that's how much was contributed to your overall flexible budget variance from the fact that actual selling price is higher than budgeted selling price, holding everything else constant. It's something very important to remember here. We're trying to disentangle the effect of every component holding all the other components constant. We wouldn't be able to say anything about anything otherwise. Okay? Now we look at the next line. From now onwards it gets easier. Now the difference between the 600,000 and the 621,000, as you all know, is entirely driven by your actual material cost per unit being higher than your budgeted material cost per unit. So we're going to call this the direct material cost variance. We're going to call this the direct labor cost variance, and so on and so forth. Each of these are cost variances, and they simply take the name of whatever cost they represent. Okay? This is your variable overhead cost variance, and this is your fixed overhead cost variance. What is the direct material cost variance in this example? $21,600 what? Favorable or unfavorable? Actual costs are larger than budgeted costs, so that is a unfavorable variance. Okay. Similarly, the direct labor cost variance is 38,000 in magnitude, and in direction it is consistent with the above. It is also unfavorable. Okay. Your variable overhead cost variance, 10,500, again unfavorable. Anytime your actual costs are higher than budgeted costs, that is an unfavorable variance. Okay. And finally, your fixed overhead variance, also unfavorable. So we've broken out the flexible budget variance into how many components? 1, 2, 3, 4, 5 components, and each of those components tells you exactly how much of the variance came from each of these factors. Questions? Is anyone confused about the direction of the variances? What is a favorable and what is an unfavorable variance is the opposite for revenues and costs. A favorable variance is anything that causes your actual income to be higher than budgeted income, holding everything else constant. So if your actual revenues are higher than budgeted revenues, holding everything else constant, that means what? More income or less income? More income, so favorable. If actual costs are higher than budgeted costs, holding everything else constant, that means more income or less income? Less income, so unfavorable. Okay? Never ever forget this. It turns out to be a very common source of mistakes. Okay, so now we've broken this out into a bunch of different variances. Let's put that information down here. We have a selling price variance, 50,000 F, plus a direct materials cost variance, 21,600 F, plus a direct labor cost variance. How much is it? 38,000. Okay. Now, at every step, like I said before, you want to make sure you add up all the components that you disaggregated and make sure that you get what? what you started out with. Okay? So in this particular scenario, I want you to add up all the components and tell me what you get. These are the 5 components. Okay, you add up all the components and make sure that you get the original variance that you started out with. Okay, when you add up these variances, what do you get? Does everyone get the original variance? Why don't you all pick up your calculators, please, and do the verification before we move on. 29,100 unfavorable. Everyone is able to get 29,100 unfavorable? Okay. Is there anyone who got 129,100? Okay, why didn't you ask me that? Okay, so the reason I want all of you to verify this on your own is because I want you to note something that's not immediately obvious until it's pointed out. What do you need to do when you add up these 5 variances? This variance is a favorable variance. It's going in one direction. All of the other variances are unfavorable variances. They're going in a different direction. So really, you cannot simply add all these numbers ignoring their signs. It's like adding up positive numbers and negative numbers, but without incorporating their signs. Okay? So here's an easy way to remember to yourselves what you should do. Think about favorable variances being positive numbers, and think about all your unfavorable variances as being negative numbers, and you'll never go wrong. Okay? So this is why it's so important to always cite the amount as well as the direction of the variance, because unless you have the direction of the variance, you don't know if that variance is a positive number or a negative number, and how you should treat it in any calculations going further. So it's pointless to know the magnitude only without knowing the direction of the variance. Okay, so this is 50,000 favorable net, and this is 79,000 unfavorable net. So 50,000 minus 79,100 should give you 29,000 unfavorable net. This is how you aggregate variances. You must always incorporate their signs. Okay? Now, I hope you all did that calculation for yourself, because I want you to remember it. Right? I don't want you to make that mistake when you go home and do the homework or do this on an exam. So there's a very important point that comes out of this implication. Okay? You could have a variance that's very small in amount. It looks smallish in amount. So that's exactly what we have here. The flexible budget variance doesn't look like a big deal compared to the sales volume variance, right? It's smallish. So you could have a variance that's relatively small in amount, but when you disaggregate it, you might end up pulling out of the disaggregation 2 variances which are each individually much larger in magnitude, but going in opposite directions. Okay? So if you want to take it to the logical extreme, you could hypothetically have a situation where your final variance is 0. So you might think that there's absolutely nothing wrong, everything is going exactly according to plan, but when you disaggregate that variance, you might pull out a 1 million favorable variance from something and another 1 million unfavorable variance from something else, and these two variances just end up cancelling each other and producing a 0 or a nothing net variance. So the moral of the story here is it's very important to disaggregate your variances to the extent possible. Because if you don't disaggregate, you might look at smallish variances and decide that everything's going according to plan, whereas it might actually be that something is going very well and something else is going very badly, but you will never get to that, and you will never be able to comprehend that unless you disaggregate your variances. Okay? Does this example make that clear to everyone? Here's also very important always to use all the information you have and try and disaggregate your variances as much as possible, and never dismiss any variance simply because it is small in amount, because you could unpack. When you unpack that variance, by unpack I mean pull out all the component variances, you might unpack individual variances that are much larger. See, and that's exactly what you have here. The flexible budget variance net is only 29,000, but there is a 50,000 positive selling price effect, and there is a 79,000 negative cost effect. These are actually two much individually larger effects in magnitude that just simply happen to be in opposite directions, and so they net out to produce a much smaller variance. Okay? So first I'm going to speak about three sort of important rules for variance analysis, and this is the first rule. You always disaggregate your variances as much as you can, because you might end up unpacking larger and larger variances every time you do the disaggregation. So the component variances really that you come up with need not all be going in the same direction as the final one. You could have a net unfavorable variance, but they could be both favorable and unfavorable effects lurking inside that are waiting for you to find them. Okay? Now all of this that we've done until now is what we call a level 1 variance analysis. Okay? So now let's use the time that we have left to go on to please try to introduce level 2. Now, if there are any questions about what we did until now, I'm happy to address them. Are there any questions? Okay, so now we need some additional information, okay, to move on to level 2. And I'm going to ask you to turn to the end of page 10 of your notes, please. Okay, and we're going to be using the additional information that's given right here. And I want you to review all of this discussion in between yourself. It just breaks down step by step everything that we talked about in class. Okay, so we're going to review some extra information that's given to you right at the end of page 10. Okay, so now what we want to do in the level 2 is, you might have guessed this already, we want to try and take some of these variances that we came up with at the end of level 1 and try to break them down even more. Okay? So we're going to be focusing on breaking down the cost variances. Okay? So just as an example, we're going to work with the direct material cost variance. And the same principle, the same logic applies to breaking down all of the cost variances. Now clearly, this is an issue of some concern, right? Direct materials cost us 21,600, more than they had to or more than they should have for a production of 10,000 jackets. Now, there's any number of reasons why this unfavorable variance could have resulted, right? When you actually think about it, this is a jacket manufacturing, some kind of textile manufacturing, right? So most likely, let's try to visualize what this looks like. So that material that they're talking about, that probably refers to fabric of some kind. right? And let's assume that an entire 10,000 refers to one specific type of jacket that's being made and sold. So there's already a design in place, right? And the design calls for a specific kind of material, and it maybe also calls for a specific cut and patterns, or specific amount of that material to be used for each unit of production or for each piece, right? Now, when we're trying to drill down to what caused that unfavorable cost variance, there are two broad kinds of reasons. Okay? There's two broad kinds of reasons that may have generated that unfavorable cost variance. I want to see if any of you can use what I just said to try and talk about or describe the two broad kinds of reasons for that unfavorable cost variance. Keep in mind, it's a material cost, okay? So, and there's a design for every jacket that calls for a specific kind of material that we're going to buy. We're going to pay a specific price per yard or per square meter or whatever it is. And there's also going to be a specific amount of that material that we need to use for each jacket. And this is how it works for every input that goes into manufacturing, right? Even if it's not material, even if it's not textiles, if it's oil, for example, there's a specific price that we're expecting to pay per gallon of oil, and there's probably a specific amount of oil that you need to make each gallon of lubricant or whatever it is, right? This is how it always is with anything that goes into your manufacturing process. There's a specific price per unit, and there's also a specific quantity that we expect to use. Okay, and the two broad reasons for a cost variance relate to these two components, price and usage. Your direct materials cost variance could be what it is, either because every yard of material cost something more than it should have cost us, right? So that's what we call a price effect, right? Or it could be because for every jacket that we did end up making, we used what? More yards or more meters than we were expecting or we were budgeting to use. And you see that that's something very distinct, very different from a price effect, right? The second one is what we call a usage effect or an efficiency effect, okay? So cost variances broadly can arise from these two effects, price effects and or usage effects. You could have both, by the way. It doesn't have to be one or the other. But the two of them are conceptually distinct because the reasons for them are very different. So let's try to think about this as being a price effect, and then we'll figure out exactly what it is. But suppose it were a price effect. So every yard of that material, or every gallon of oil, or every pound of copper, or whatever it is, cost more than it should have cost. What do you think are some of the potential reasons for that? Well, it could be things like there was a worldwide shortage of copper, and so the price of copper just went up per pound. Or there's an oil strike, and the price of oil per gallon is just shot up. Is this something that's necessarily within the control of the person who's responsible for it? A lot of the time not, right? So price effects can sometimes, a lot of the time, be outside of the control of the people whose performance you're evaluating. Now try to think about usage effects. Every jacket was supposed to use, let's say, 10 yards of material, but we ended up using about 11 yards of material. Why? Because we weren't very efficient in cutting, we wasted a lot, we didn't cut efficiently, or our workers weren't well trained enough, or there was something wrong with our machines, and so on, right? Those reasons tend to be a lot of the time, more internal or more external? A lot more internal. Okay, so there's a conceptual reason why we distinguish between price and usage effects, and I also want you to understand that price and usage effects are not confined to material alone. Okay, they exist for anything that's an input into your production process. So you can have price and usage effects for labor also. A price effect arises when you pay workers for each hour of their time something more or something less than you were supposed to have paid. Right? A usage effect in labor arises when, let's say, you were supposed to use 2 man-hours to cut each jacket, but you ended up using 2.5 man-hours to cut each jacket. Okay? The same kind of price and usage effects exist for anything that's an input into your production process. Utilities or electricity. A price effect could arise when every kilowatt hour of of electricity costs higher or lower than you expected to. Like a usage effect could arise when, suppose you were supposed to run your machine for 15 minutes to cut each jacket, but you ran your machine for 17 minutes, so you ended up using more electricity. Is there anything that's an input into your production, you have price effects and usage effects. So in order to understand any kind of cost variance better, we need to distinguish between price effects and usage effects, because you see, they're very, very distinct. They're very different kinds of factors, economic factors that are driving these two. So how do we do that here? Do we have enough information to break this variance down into a price variance and a usage variance? Right now, on the board, we don't have enough information with which to break down, okay? But that's what we're going to try and do. We're going to incorporate some additional information. I'm going to ask you to look at that information that's at the bottom of page 10. So now let's investigate the direct materials variance and the direct labor variance more carefully. We're going to focus on the materials. 21,600 U. Suppose you are also given the following information. Okay? So we're just going to use what's given for direct materials, okay, to illustrate the concept. So how many square yards of cloth did you purchase and use? You used 22,200 square yards in total for all the jackets, okay? The actual price that you incurred per square yard is $28 a yard, okay? And that's what gives you your actual direct materials cost. Okay, 22,200 yards at the rate of 28 per yard, you can verify for yourself, works out to 621.6. Excuse me. You can just skip the information for direct labor. Let's move on to what's immediately underneath that. The budgeted usage of direct materials was 2 square yards per unit of production. So how much material were we budgeted to use per jacket? 2 yards or 2 square yards per jacket, okay? And the budgeted rate for the material was $30 per square yard, okay? So let's just put down all of this information. What is the budgeted price per yard of the material? What's the budgeted price per yard? $30 per yard. The budgeted usage of yards per jacket. 2 yards per jacket. Okay. Now the actual price. What was the actual price per yard? 28. The actual usage of yards per jacket. So the actual usage of yards per jacket. 2.22 yards per jacket, okay? And you know that because you're told you use a total of 22,200 yards to make 10,000 jackets. So that's an average of 2.22 yards per jacket, which comes from 22,200 yards. Okay, so now you kind of sense that you have all the information that you need to break out the price effects and the usage effects, right? So your budgeted price, actual price, budgeted usage, actual usage. You should be able to break out the price and usage effects. The question is how. Now, before we get into the actual math, okay, I want you to use your intuition and try and tell me at least the direction of the effects. Look at the price effects first. Do you think the price effect is a favorable one or an unfavorable one? It's a favorable one because we got the material for an actual price of something lower per yard than we were budgeting it. So the price effect is pushing down your actual cost relative to budgeted cost. How about the usage effect? It's going in the opposite direction. It's going to push up your actual cost because you used a lot more. You used about 10% more of the material than you should, or 11% more than you should have used. And you know that the overall of the price effects and the usage effects works out to unfavorable because that total thing is 21,600. So let's start out with this. This is what we want to break down, right? So I'm going to put down where that number came from, okay? So the flexible budget amount was 600,000, and the actual amount was 621,000, and it is from offsetting these two that you end up with this. We start out by putting out what we compare. Okay. Now, we're going to do some decomposition. We're going to do some breaking down just like we did here. Okay? We broke every number down into its elements, remember? So we're going to do the same thing here. So this is 10,000 jackets at a price of 60 per jacket. This is 10,000 jackets, 62.16 per jacket. Now, can we decompose this further using this information? Can we decompose this further using this information? We want to try and decompose that number down into a bunch of irreducible components. Where did the $60 per jacket come from? Just look at this board. Yes. So that's where the 60 came from. Right? It came from $30 a yard budgeted times 2 yards per jacket. Okay? So let's put that down. 10,000 jackets, $30 per yard times 2 yards per jacket. How about the 62.16? Where do you think that came from? Came from the same thing. Came from $28 a yard times 2.22 yards per jacket. Okay, you can verify, you can multiply these two and verify for yourself that that equals that. Okay, so 10,000 jackets times an actual price of 28 a yard times an actual usage of. Okay, I'm just going to erase this stuff in order to create a little bit more space for myself. Now, how can we distinguish, how can we break out the price and the efficiency effects here? We put down all the information that we have in a very concise form, right? So how can we proceed to break this down into a price effect and a usage effect? And you should know from your intuition now that the price effect and the usage effect are each individually going to be larger or smaller in magnitude than this. Each of the price and usage effects individually are going to be larger in magnitude or smaller in magnitude than this. What did I hear you say? Smaller in magnitude. They're going to be larger in magnitude because we just noted that one of the effects was favorable and the other one was unfavorable. So they're going to net out to produce 21,600. So individually they both have to be larger in magnitude. Okay, so that's the one thing that you know, but you don't know anything else. So luckily, this level 2 variance analysis is going to proceed exactly like the level 1 variance analysis. We are going to add an intermediate step here. And how do you think that intermediate step is going to be composed? It is going to be composed using some elements from the flexible budget and some elements from the actual. So I'm going to call this step a level 2 flexible budget. But this is not a word that's in your textbook, I think. Okay? This is just my name for it. Okay? So let's see how we compose this level 2 flexible budget. Well, the first element is absolutely clear. There's got to be a 10,000 jackets in there because it's the same on both sides, right? Here's how we're going to do it. We're going to take budgeted price from the left and actual usage from the right. Okay? And you're going to combine those together. Let's put that down for a second and get that up at the board. So now I want you to compare, sorry for the mess. compare these two expressions. 10,000 times 30 times 2 and 10,000 times 30 times 2.22. You know there's going to be a difference between the two, right? And that difference is what effect you think? I didn't ask for the direction, I asked for the name. What effect do you think it is conceptually? What effect do you think that is? No, we are only talking about one of two effects, either a price effect or a usage effect. My question is, what effect do you think that is? It's clearly a usage effect, because usage is the only thing that's varying. We're keeping everything else constant. So this difference is your usage variance. It's also called your efficiency variance. Okay. Now I want you to compare this number to this number. 10,000 times 28 times 2.22 and 10,000 times 30 times 2.22. What do you think this effect is? Clearly it is your price effect. So by adding this intermediate step here, what we've done is we've allowed ourselves really to hold everything else constant except usage here and except price here, and that way we're able to isolate out the price effects and the usage effects. Now, this is 600,000. You know, what is this number? 666,000. This is 621,600. So what is the magnitude and direction of the usage effect? 600 compared to 666,000. So your usage effect is 66,000. Favorable or unfavorable? Unfavorable, because your usage is driving up your costs by 66,000. Okay. How about your price effect? 666 compared to 621,600. So it is 44,400. But what? Favorable, because you're getting the material at a lower price, remember, so that's driving down your actual cost relative to your expected or your budgeted cost. So your usage variance 66U and your price variance 44,400F. You aggregate the two and make sure that this is what you get, and that's what you get, right? 66,000 negative and 44,400 positive should give you 21,600 negative. So we've just broken the cost variance out into a favorable price variance and an unfavorable efficiency variance. Any questions about this?